Could you be missing out on some of the world's best investment opportunities? International investing might seem like a complex strategy reserved for only financial experts or large institutions. But the reality is that investing beyond our U.S. borders can be an essential part of any well-rounded portfolio. Hi, I'm Keith Demetriades. Today, we'll explore the principles behind international investing, why it matters, and how it can fit into your financial strategy. Let's begin with a simple question. Why would you want to invest outside the United States in the first place? After all, the U.S. has some of the world's largest, most successful companies, right? Yes, this is true, but it's also true that not all economies move in sync. When the U.S. market faces a downturn, other regions like Europe or Asia may be experiencing growth. By investing across multiple countries, you're adding another layer of diversification, which provides another opportunity for enhancing returns and also adds an extra layer of protection to your portfolio. Think of it as building a solid support structure. If one pillar weakens, the others can still hold firm, keeping your overall portfolio stable and balanced. When you invest solely in U.S. companies, your portfolio's performance is tied directly to the U.S. economy, which can be great until it's not. Adding investments from other countries can allow exposure to global economic growth and tap into industries not heavily represented domestically. Often investors focused on U.S. companies say, but the companies I'm invested in do business globally, so I'm covered. I don't really need to invest internationally. The potential problem with this rationale is that those U.S. multinational companies often hold a lot of technology and healthcare and might be severely underrepresented in other important parts of the global economy, like basic materials. In fact, some of the most dynamic growth opportunities right now are outside the U.S. market. Take emerging markets, for instance. Places like India, Brazil, and parts of Africa are experiencing rapid economic growth and development. These regions are building new industries and infrastructures, creating the potential for high returns that you might not find in more mature markets. Investing in these emerging markets is a bit like getting in on the ground floor of a startup. Imagine being able to invest in the U.S. tech companies back in the 90s before they became global giants. Emerging markets offer a similar kind of potential. Now that's exciting. But we all know there isn't any lightning in a bottle. There's a trade-off. The potential for higher reward generally comes with the potential for higher risk. These investments can be more volatile, and there's a greater chance of economic or political upheaval impacting returns. That's why it's crucial to approach these opportunities carefully and ensure they fit within your broader investment strategy. While the potential for growth in international markets is exciting, it's also essential to understand the risks involved. Buyer beware of a few things. One of the primary concerns when investing internationally is currency risk. When you buy a stock in a foreign company, you're not just investing in that company. You're also investing in that country's currency. Let's say you invest in a European company, and the value of the euro drops against the dollar. Even if the company's stock price goes up in euros, when you convert those returns back into dollars, your gains might not be as high as you expected, and you could even lose money. Currency fluctuations can significantly impact your overall returns. So there's something to be mindful of when considering international investments. Another factor to consider is political and economic stability. While the U.S. has a relatively stable political and economic environment, not all countries can say the same. Political unrest, sudden changes in government policies, or economic sanctions can all dramatically impact the value of investments in that country. For example, Venezuela was once one of the wealthiest countries in South America, but due to political turmoil and economic mismanagement, it is currently one of the most unstable markets for investors. So it's crucial to research and stay current on the political and economic conditions of any country you're considering investing in, or choose managers that do this for you. Geopolitical risks add another layer of complexity. These risks include international conflicts, trade disputes, or changes in global relations that can influence economies and markets. For instance, trade tensions between the U.S. and China have had ripple effects across global markets, affecting everything from manufacturing to technology. During the COVID-19 pandemic, different countries responded in unique ways, impacting their economies and stock markets in diverse and often unpredictable manners. A diversified portfolio with international exposure can help investors navigate these types of uncertainties more effectively. When one market is hit harder than others, having investments spread out globally can potentially provide a cushion against drastic downturns. Now, the last hurdle for potential international investors may be self-inflicted. Let's address some common misconceptions about international investing. One myth is that international markets are inherently riskier or less stable than the U.S. markets. While it's true that emerging markets can be volatile due to political or economic instability, not all international investments are high risk. Developed markets like those in Europe or Japan often have regulatory frameworks and economic structures comparable to those in the U.S., making them relatively stable environments for your investment. These regions can offer compelling opportunities for diversification, especially in sectors that may not be as prominent in the U.S., such as European luxury goods or Japanese technology. Another misconception is that international investing is only for sophisticated investors or those with extensive knowledge of foreign economies. Gaining exposure to international markets doesn't require a deep understanding of geopolitical nuances or foreign financial systems. Mutual funds and ETFs that focus on international assets provide a simple and accessible way to invest globally. These investment vehicles are managed by professionals who handle the complexities of selecting and balancing international holdings, making it easy for even novice investors to benefit from global diversification. Along that same line, people often assume that adding international exposure will complicate their portfolio. But the goal is to complement, not complicate, your investment strategy. Integrating a mix of domestic and international assets can potentially reduce overall volatility and enhance returns without significantly altering your portfolio management approach. Then there is the real thing called home bias. This is a tendency for investors to prefer putting their money into companies and assets from their own country, often because they feel more familiar or comfortable with them. It's a pretty natural response, but it can lead to missed opportunities. For example, if you only invest in U.S. companies, you might miss out on opportunities in industries where the U.S. doesn't dominate, such as European automotive manufacturing or Asian consumer technology. And while it's true that the U.S. market has produced strong returns in recent history, sticking exclusively to domestic investments can create a portfolio that overlooks those diamonds in the rough and leaves your money overly dependent on the U.S. economy. This is an important concept because in recent years, sticking exclusively to U.S. investments hasn't always been the best strategy. While the U.S. market has certainly had some strong performance, it's also faced significant challenges, from economic slowdowns to political uncertainties. At the same time, some international markets have shown resilience and potential for growth, especially in regions undergoing economic recovery or development. Europe is a current example. As it rebounds from the economic difficulties of the past decade, sectors like renewable energy and technology are showing promising growth. Similarly, Asian markets, particularly in countries like India and Vietnam, are seeing rapid development and modernization, which can create unique investment opportunities not found in more mature markets. By diversifying into these areas, you're not just spreading risk, but also positioning yourself to benefit from the growth of emerging economies and industries less correlated with the U.S. market. As with most things, the key is finding a balance. I'm not talking about abandoning U.S. investments, just adding some global exposure into the mix. This way, you create a more dynamic and resilient portfolio that's better equipped to participate in those non-domestic opportunities, while also better handling the ups and downs of different economic cycles. As we look to the future, there's reason to be optimistic about international markets. Diversifying beyond your home country can help you tap into this potential while reducing the risk of being overexposed to the economic fluctuations of a single economy or market. From a retirement perspective, it's especially important to consider adding international exposure to your investments to provide this extra layer of stability and flexibility, helping protect your nest egg from the unexpected but inevitable shocks to our markets. Now that we've discussed the concept of international investing and its importance, let's talk about how you might begin. Do you need to buy stocks in individual companies in these countries? Not necessarily. One of the most straightforward ways to gain international exposure is through the managers of mutual funds and ETFs, exchange-traded funds. These are essentially baskets of stocks and/or bonds that include a variety of companies from different countries. For example, a mutual fund might invest in a range of European companies, or an ETF might track the performance of the entire Japanese stock market. Using these investment vehicles can spread your money across many companies and industries, while leveraging management expertise to uncover opportunities and manage your risk. You could also invest in global companies listed on U.S. exchanges. You've probably heard of companies like Toyota, Nestle, or Samsung. These are all international companies, but you can buy these stocks on the U.S. exchanges just like any other American company. This approach exposes you to global markets without having to manage foreign exchanges, tax complications, or currency conversions. So now that we know that there can be some real benefits to investing internationally and some specific investment vehicles to consider when tapping into the international space, let's discuss how you might successfully implement international investments into a well-balanced portfolio. Investing overall is about finding the right balance between risk and reward. And that philosophy also holds true when incorporating international investments. Many investors start by considering a strategic allocation of 15 to 25% of their overall portfolio. Other investors find using a core satellite strategy to be an effective method. This strategy divides your investment portfolio into a core and then one or more satellites. The core makes up around 80% and is comprised of domestic investments. The satellites are tactical additions that make up around 20% of the total and focus on investments in international, niche, or specific sectors. The idea is to use these satellite investments to enhance your portfolio's performance and resilience without overwhelming it. It's a way to carefully introduce measured amounts of international investments when there are apparent and timely opportunities while keeping your core investments stable and aligned with your long-term goals. In my experience, international investing is like adding customized steel reinforcements to a building structure. The foundation of your portfolio might be built on solid domestic investments, but adding international assets provide more strength and more flexibility for extra protection during market drops and extra participation in some very unique opportunities. If you're thinking about adding international investments to your portfolio, it's important to be strategic. Look for areas that complement your existing holdings rather than simply duplicating them. For instance, if you already have a heavy concentration in U.S. technology stocks, consider adding international investments in consumer goods or healthcare sectors to balance things out. This way, you're further diversifying your portfolio without increasing exposure to the same risks. One of the most critical steps in getting started is to clearly understand your financial goals and your risk tolerance, because it will determine the right amount and type of international exposure for your portfolio. Your responsible stewardship in managing your money today involves thoughtful planning for your financial future. For many investors, beginning with a small allocation, say 5-10%, to international assets is a good approach. You can gradually increase your exposure over time as you become more comfortable. Here's a simple step-by-step approach to getting started with international investing. First, assess your current portfolio. Look at your exposure to alternatives, niche investments, and international markets, then decide if you want to increase your international allocation. Next, identify your goals. Are you looking for growth, income, diversification? This will guide your choice of investments. After that, choose your investment vehicles. Decide whether individual stocks, bonds, mutual funds, ETFs, or some other investment vehicle fits. And finally, monitor your investments regularly. International markets can be more volatile, so it's crucial to monitor their performance and make adjustments as needed. Remember, international investing can be complex, but it doesn't have to be overwhelming. This is a good topic to discuss with a financial advisor who can help you determine the right amount of international exposure for your portfolio and guide you through the process. They can also help you navigate the complexities of different markets, currencies, and investment vehicles to ensure that your international investments align with your financial goals. If you're curious about how international investments can fit into your strategy, I encourage you to explore your options and see what approach might work for you. I'm Keith Demetriades, and if you found this video helpful, don't forget to like, subscribe, and share it with others who could benefit from this information. Be a savvy steward. Make your life count.